All right, good afternoon, everybody. We're almost 2 minutes late on the meeting because I was having to educate Penny about the Long Island bagels. Telling you, it's the Long Island bagels. All right, let me do the disclosure before I get in trouble because compliance would not want me to be talking about bagels before I do the disclosure. Let me tell you, I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. Yeah, it's specifically the Long Island bagels and the New York City pizza. New York City pizza is unbeatable. And if you're from Chicago, don't even try to tell me about Chicago pizza as being better or any nonsense like that. Chicago pizza is like Pizza Hut. New York City is where it's at for the pizza. Long Island for the bagels. The other places you guys can have your thing, but it's not gonna be any of that. Yep. All right, let's hop into this meeting. All right, so we got a little bit of a snapback day today. SPY's up 0.75%, Q's up 1.1 or so. IWM is up 0.7%. So pretty tasty day. The opening price action I thought was really tricky how they sold the gap. Not that they sold it, but the way that they sold it. So, we had a little bit of a common gap up this morning where we were flirting with the potential gap up above yesterday's high. Keep in mind that yesterday for the SPYs and the IWM was an inside day. For the Qs, it was not. But I love those inside days like we spoke about in yesterday's afternoon meeting because they give you clarity and they give you something that you can focus on as a reference point on those tighter rest days. Very simply put, inside day and up, you're generally going to want to be long. Inside day and down, you are generally going to want to be short. So that's what we wanted to see. And even though we were flirting with getting above yesterday's high, the inside day high for the SPYs pre-market, we actually ended up opening just below the inside day high, and that's fine. I want to see the market trade through, get above, and hold above yesterday's high when we're no longer extended. So you can see here when we're first opening, because of the gap, we're opening up and we're a little bit extended to the upside. That's normal. It's fine. When you have extension in the marketplace, you always want to be careful about buying your stock because you're buying something that's extended. Same thing is always going to be true on the other side. It doesn't mean that it can't go up. It certainly can go up, especially if there's momentum. When do we most often see momentum? We most often see momentum at the open. So it's not completely out of the equation to see a gap up that gives an immediate momentum move, but it would be a momentum move. That's the only way that you're really able to get continuation in an extended market is if momentum is actually coming in. And no matter what, even if you had a momentum move to the upside off the open with a gap up, you will still need to have price or time correction at some point to let those moving averages catch up. It's basically like a law of trading. An extended market can become more extended, but eventually you have to have a correction through price or time. So that's the first thing I want to see on the open. Cautiously optimistic again this morning, even though our big picture trend is down and our small picture trend is broken and is more neutral. I'm cautiously optimistic just because we were gapping to that yesterday's high type of situation. Really wanted to see, can we get above it? Can we hold above it? And the immediate answer was just looking like no. They just smacked this market down. This is exactly what I did not want to see off the open if I was trying to be bullish at all. If the market could go sideways a little bit, let the moving averages catch up, then we clear yesterday's high. That's ideal. If we get a little bit of a kind of grindy move down over the course of 15 minutes as the moving average is catching up, and we work our way down to 394.50 from almost a 395.50 open, so you pull back $1 over the course of a few bars, then you get a pivot point right into the ADMA, and then that leads to a break of yesterday's high. Also something that I would really want to see. What I don't want to see, if I want to be bullish at all today, is opening momentum selling. And I made sure to caution that over the course of these last several weeks, it seems like almost every time we gap up, that's exactly what we get. We get this heavy, immediate selling that's coming into the market. And what made some of these days over the course of this last month or so tricky is we would gap up, have like momentum selling through the day. We wouldn't really get real downside continuation because the market was overall bullish on those smaller time frames, and then eventually at some point in the afternoon we'd end up breaking highs and we'd be kind of starting to grind up into the afternoon for like maybe a decent close. But all the same, not what you want to see if you're looking for an early break of the inside day. You don't want to see a full gap fill coming in, which is basically what happened. SPYs straight down off the open, more downside continuation by the third 5-minute bar into the 21 EMA, just about filling the gap. Qs went negative. They ticked below that important 280 once again. IWM straight down, also ticked negative. IWM I really felt was like leading us down. It was the worst thing that was out there. And then all of a sudden this pivot low comes in at 945. And I think my remark was, you can go long off this low. We definitely called out going long off of the low. But I very specifically used language of using a game plan that is not going to be greedy. Because that momentum selling that we saw in the beginning of the day here with the Qs, the IWM, and the SPYs, it really does gonna tend to mean that you have a not great probability of seeing a new high on the day. Obviously, within 10 minutes, we made a new high of the day. And that just goes to show that the volatility out there, even on like what turned out to kind of be another rest day at the end of the day, there was still so much volatility out there. It seemed like liquidity was really light. It was very easy for this market to kind of get pushed around. Yeah, so I'm like, all right, take your longs here if you want to have a conservative game plan. It's hard to expect too much because of the momentum selling and the gap fill and the Qs and the IWM going negative. And 10 minutes later, we're breaking highs. And even as we worked our way up, I was like, all right, this is good, but be defensive. If you can break highs on all three indices, you begin to get a little bit of an all-clear sign. And that's what happened. IWM at the end of the day here is actually the weakest. But we end up breaking that high. Honestly, impressive. This was so crazy. The way we had this opening momentum selling, followed 15 minutes later by this opening momentum buying. And then some of these moves, like this move that we had here at 130, was also pretty wild, like back up to highs just to get wrecked all the way back down. I know that there was something kind of came out there. You had Microsoft, the ATVI news kind of hit, and there was a couple of things going on at the same time. But just like a lot of whippy ranges in what really at the end of the day here is another consolidation day. But anyway, we ripped higher, we got extended, and I was calling for 397 resistance in the SPYs and 182.50 resistance in the IWM. And as we were extended into the areas that I thought, and I didn't necessarily mean to the penny, I just kind of meant broadly as an area, that I thought would act as some resistance for the marketplace, that's really kind of where we stalled out. And the only reason I came up with those numbers was, and I'm not like a fib guy, but it was really just a percentage retracement of kind of this 2-day down move or this second day of trading, where I thought that this is really what I was looking for yesterday, was an appropriate snapback after for day 3, I felt was going to be a bounce back to 397, and I was really disappointed yesterday that I couldn't get my bounce back to 397. I actually got it today, even though I would characterize getting the bounce to 397 is lower probability today than yesterday, because yesterday's consolidation and inside day is going to be more bearish than bullish, and we did not exactly close well. So I got the bounce that I was looking for yesterday today, this kind of snapback to 397. A lot of the levels that I've been looking at here for the last couple of days, I mentioned in the morning meeting game plan, like basically just refer back to the previous day's levels. So, we're looking at Apple 140, which held yesterday. Didn't really give you another chance on that one today. Amazon 88 actually worked out really well today. AMD, back through 70, but AMD we recognize as being kind of a very relatively weak one. NVIDIA 156, you kind of needed to have that stock from yesterday. It made it a little bit trickier to be able to get it. Shopify 37, But Chop had that sell initiation this morning, so we're being a little bit more cautious on that one. I did end up trading it and making a few bucks on it, and it's impressive that it was able to kind of close green on it. So all those levels were still kind of in play with this market as it worked its way up. I don't think that the buy here was easy, even if we did call out the long versus the low. This is just not. I just don't think this is normal price action to get a momentum selling on a gap up in a market that's become more bearish, that within 15 minutes gets momentum buying coming in on like no real news. Pretty sure there was no news, right? Someone confirm that for me. No news coming out over the course of this 20 minutes. It was just the market was like, okay, we changed our mind and we decided after ripping down we're going to rip up. It's like not normal. But still got the move that I was looking for. We got right into the kind of the area where I thought that the market would hold. We called out for booking profit on longs into 397. I hope traders did that because it more or less turned out to be the high of the day, even if they went back up and they smacked it again. This pullback here was too deep. I remember noting that in the IWM. Like if you wanted today to turn into one of those upward grind days, which I feel like we haven't seen one of those in a while, where you get that strong move that gets you a little bit extended, and then the 21 on the 5, which is basically the 8 on the 15, begins to catch up, and that turns into like an algorithmic upside buy grind. There was some chatter that maybe we could see that come in, but the depth of the sell-off, particularly, I think when you're looking at the IWM here, was just too heavy and kind of put that out the window. So once I saw how heavy the IWM sold off, I was like, honestly, best case at this point is going to be a trend day, is going to be a range day, and worst case is going to be actually that we reverse back down again. And it turned into the first one of those situations where it was really kind of just a sloppy range day with particular weakness in the IWM. Still managed to hold this 180, 180.50, which has kind of been an important area. But at the end of the day, it's further rest. Even though it's a little bit of a snapback, I would still characterize this action as more bearish than bullish. We might I'm not a big trend line drawing person. But they can be self-fulfilling prophecies. It's not unusual when you have a channel like this that breaks to the downside that it even retests to the upside and then holds as resistance as the market begins to kind of create a reversal pattern and work its way lower. So we'll see if something like that happens. You would actually be looking for an even bigger bounce to kind of retest the trend line on the upside to see if it actually fails. But that could happen tomorrow. I mean, PPI tomorrow. Another wild card, like I've been partially complaining about recently. We're just in such a macro-driven market right now. It's always all about the next number. It's about the next number. It's about the next number. And, we're finally going to be having it here with the PPI tomorrow, the CPI on Tuesday, and then the Fed on Wednesday. The CPI has been giving us much bigger reactions than the PPI in general. But the PPI is happening first this time around, which is unusual. I remember the last time that happened was in June, and someone here in the VTF told me about a rule that happens with something or another that can make the PPI actually come first, because I don't think that is typical. But it's happening again here for December. The last time that happened was in maybe like the most atrocious sell-off of the calendar year, which was in June. How do I zoom again? There it is. I'm not calling for a repeat of this, by the way. I'm just looking at it. We were in this big downtrend. We had worked our way up. We were trying to break this downtrend line here. We were making this bullish consolidation at the end of May and the beginning of June. Kind of going sideways, building out this pattern. We wanted to see which way this pattern would break. And this was the day... I actually can't remember how it was. I'm pretty sure that this was CPI and this was Fed, and this is where they front ran it. So maybe the PPI came out up here. If I'm correct, if my brain still works, which doesn't always work. I think that's accurate, but I know we saw that PPI come out one other time. I think it was June, and I think that was with this massive you know, the sell gap down and the next gap down. This was just like incredible. Again, not calling for a repeat of that. I have no idea what the numbers are going to be tomorrow. The outlier numbers, you know, big miss on expectations in one direction or the other is what will create the big movements. It looks like we've seen a lot of option flow pricing around that $400 area for the SPYs. So we'll see what that number looks like, and if that 400 can become a magnet at all for the market into the end of the week. It certainly wouldn't surprise me. And that 400, I think, would also coincide with the retest of this uptrend channel line on the other side of it, which should be interesting if that happens. And 400's been a big psychological level here over the course of the last month or so. It was big resistance. We broke out on the Powell day. We wanted to see if it would act as support. It did for one day on the jobs number day, and then failed, and then failed after that. So for the moment, we have an inside and up for the SPYs, which you could certainly argue is bullish, but I would still characterize this market as neutral to bearish with kind of where we're at right now. That's our SPYs. But we did still hold above some key levels, right? We're still above SPY 390, and we're back above SPY 393.50, which I think is a key level. We're still above QQQ 280, which is a key level. And yeah, the IWM like 180.50 is kind of the spot, but this IWM has been weakest. I don't think it looks good. And I would note, as I look at the IWM weakness on the daily here, that it seems like, oh, I just moved my moving averages. It seems like whenever this market is having its breakdowns, that the IWM is usually what kind of goes first, even on the daily chart. So definitely concerning. But yeah, we'll see how that number plays this market tomorrow. A lot of the other things that were in play today, for the most part, that I was looking at outside of the bigger levels that I already mentioned, didn't trigger. So, you know, it's kind of no harm, no foul. JP Morgan, I wanted to pay attention to 133. It didn't trigger, so we're going to have 2 inside days in a row for JP Morgan. GE, I was looking at 86. I guess it did tick above 86 real quick in the beginning of the day, so I hope no one really got suckered into that too bad. Actually, maybe somebody did, because I know that I was calling out, oh, like, geez, it's going, it's got volume, it's breaking through 86. If anybody tried that, you might have gotten pushed out of that one for a loss. I didn't want to get involved because I didn't like the degree of risk that I was going to have to put on for it. What did that BNTX end up doing? Ooh, this was a monster. This BNTX was great. Really nice. I'm not sure if anybody caught this. It fell off my radar. 166 was the spot we discussed in the morning meeting. It looks like it would have been a decent amount of risk. Just to the low of this bar is a momentum play. If you just didn't want to rely on momentum, you had to give it a lot of risk. But if you wanted to rely on momentum, you could have given it down to 165.35. So 65 cents risk, not too bad. Was that beyond meat yesterday or today? I almost can't even remember now. Oh, that was today. We're looking for that continuation through like $15.70 to $16. Oh, that's right. Man, jeez. I'm really losing it. That was today. When it broke up, I remember saying you could use the low of this bar, 935 bar, as a momentum stop, or use the low of the day. So if you just use the low of the second bar, you got shaken out of the trade. If you use the low of the day, you're able to capture this move. So it was not too bad. And the DOCN, I don't think triggered either. We were also looking at that in the morning meeting for 30. I guess it ticked above it once real quick. So yeah, not really too much to chatter about. Just the market giving a little bit of a bounce back. Some of our levels we're holding, and we'll wait on the number for tomorrow. So happy to take a look at whatever you guys got.
I definitely don't have that.
I'm bullish on New York pizza. All right. Looks like the first and only question for the moment is from Zachary. I bought GE when it hit my alert at 86. Okay. That's what I just had up here. Yeah, so this GE definitely could have taken a loss in today. looking for that breakthrough, the previous day's high to break through on this daily pattern. And it had an investor day today too, so I thought maybe there was, I mean, investor day can really be, it doesn't necessarily mean that the stock is going up. It could be that they announce something bad. They could give, guidance on what they're going to be doing or whatever, and that I feel like has just about the same probability of being negative as it does positive. But you do want to know, if you're trading GE, that it is going to be having some sort of investor day, and maybe that's actually what ended up creating this weakness and breakdown out of this pattern. I wanted to see, obviously, this is a bullish pattern, tight wedge here, inside day at the end of the pattern as the moving average is caught up. I usually love that. And you want to try to go long above yesterday's high, which is $86.08, would really be the right way to trade it. Today's high, unfortunately, is $86.19, so you easily could have gotten suckered into this for a loss. I still think it's a good trade, though. And again, the reason I didn't touch it was I didn't like the amount of risk that I was going to have to put on as it was still extended. But the volume was good. There's a lot of things to like about this trade. In the past, I would get in too late and get out too early because I was scared. I went down $50 to $100 for about 5 minutes with bearish talk in the VTF and on the charts. Oh yeah, the market was certainly not helping either. Was this a time I could have gotten out strategically, or is it good that I stuck to the strategy despite it being a loss? When the alert went off at 86, is that more of a sign to watch for a few minutes, get in for momentum, or more of a situational decision? I love this question. This is really good stuff. So, one of the questions here from Zach is like, hey, I got in GE at 86, and we all understand what the trade is. We all understand why he got in, or maybe he got in even a little bit above 86, because technically the trigger would probably be 86.08. So he's like, my alert goes off. The volume's looking great. The stock's trading well. I get in the trade. Now I'm in the trade. It's a lot of risk for me. I'm seeing that the market is trading terribly. There's bearish chatter on the VTF. Like, should I look to liquidate my position early so I don't lose my full risk on the trade? My answer to that is always going to be no. I think that the right thing to do is to leave your stop loss in and eat the full loss. Because today that trade failed. On another day, the relative strength from the volume that is here, as the market has a pullback that's maybe not as bad as the pullback that we had and gives an earlier pivot and works its way back up, and this leads to a beautiful trade. The core principle that I think is necessary to apply in trading, regardless of your trading approach, I don't care what your trading approach is, but there's a core principle to every trading approach that is the same. And that is being consistent. Whatever your approach is, you have to be able to be consistent. One of my favorite ways to describe to be a successful trader, even though it sounds so obvious, it's not as easy in practice. The way to be successful as a trader, the way to be consistently profitable as a trader, is to have a consistent approach to the market. And, that's it. The only way that you can be consistently profitable as a trader is if you have a consistent approach to the market. I don't care what the approach is, but you have to be consistent in what you do with it. The only way that you can be consistent with your approach to the market is if you have rules that govern the consistency. And I don't believe it's possible for you to be involved in a trade that you game planned and you decided to get in, and there were reasons why you got in the trade. Daily chart looks great. Stock maybe is going to be in play today. Great relative strength off the open. The volume's not looking too bad. It's given upside momentum when the market's selling off. You have all those reasons why you're choosing to be in the trade. You're deciding, all right, if this is the risk, so I'm in. I decided I'm comfortable with my risk. I'm taking the trade. I know exactly what I'm doing with this, and I'm going to let this trade play out. I'm going to take my loss, or I'm going to have my game plan for reward maximization, and I'm going to crush this trade if it really works in my favor as the way that I'm game planned for it. If you then get into trades when you have a game plan for risk management and you have a game plan for reward maximization, and then you deviate from that plan, you will never be a consistently profitable trader. You'll never be consistently profitable as a trader, because you're not doing things in regards to the market that are in a consistent manner. So it's just not going to work for you. You had a reason to take the trade. You bought the ticket, take the ride that trade out, take that loss, be comfortable with that loss, and that's it. Now, you have one other part here of your question where you go, when the alert went off at 86, is that more of a sign to watch it for a few minutes, get in for momentum, or more of a situational decision? I love this second half of the question too. So I do not think that it's a sign to watch it for a few minutes. If the trade is triggering your price, and by the way, your alert should be ahead of the price you want to buy. So maybe you wanted to buy 86.09 because yesterday's high is 86.08, and so you set your alert for $86 with the plan to buy 86.09. But if your plan is to buy $86, you should not have an alert at $86. If your plan was to buy $86, and honestly, if your plan was to buy 86.09 and your alert's at $86, this is an $86 stock, it's too close. There's a very real chance that by the time you type this thing up, it's at 86.50 and you totally missed it. You got to give yourself a little bit more room with your alerts. So if you want to buy $86, then your alert should be at 85.50. Not 85.50, probably 85.80, 85.75 even. Give yourself 25 cents worth of room. Now when that alert goes off, there is still a situational decision that you're making here. The situational decision is, it basically plays out like this. I did research before the market opened. We kind of talked about this in a little bit of a different way even yesterday. I did research before the market opened. I know what my important levels are. I know what my interesting spots are for various stocks. For example, GE, $86.09 is a spot where I potentially, based on my pre-market analysis, would want to purchase this stock. Your alert goes off. You type it up. There still is a situational decision. The situational decision is this actually showing me that it's a good trade in real time? How do you know if it's a good trade or not in real time? It's not based on if the trade works or not, because you have no idea before the trade even triggers if the trade even will trigger, let alone if it will actually work. You don't know that. What you are assessing when the alert goes off is how much risk am I going to have to put on the trade? Is that an amount of risk I'm comfortable with? If the answer to that question is no, then you almost don't even need to look at anything else and you can just move on with your life. The other portion of the question is, assuming that the risk seems like it's appropriate to me, what does the probability seem like? And then that's where your layers of probability come into play. Is the market on my side? No. Is the relative strength? Yes. Is there volume? Yes. Is it potentially in play? Yes. Is the time of day appropriate? Yes. Okay. So not everything's on my side, but I got a bunch of things on my side. So I like that. And am I comfortable with the risk? If the answer on both of those questions is yes, then you're taking the trade. You're not sitting there and you're watching it for a few minutes unless, the only reason why you would be sitting there and watching it is because it hasn't actually triggered the trigger entry. But if it's triggering the trigger entry, you're either in or you're out. Don't let it go to your 86.09 that you potentially want to buy and haven't made a decision already. Like, you need to know by the time it triggers the trigger entry that you would have for yourself based on your pre-market research, if it is a trade that you want to be involved in based off of the risk reward and based off of the probability of success. So that's where the situational decision comes in. I make this, big list for myself every day of stocks that I want to look at. Then I'm usually actually adding to that list when I'm doing the morning meeting, because you guys will oftentimes have really good ideas that I missed in my own research. But by no means does that mean that I'm taking all of these stocks through the levels that I'm talking about in the morning meeting. I probably take a minority of the levels that I actually research. I definitely take a minority. I don't know what the percentage is, but it's definitely less than 50%, probably less than 25% even. Because all of that is pre-market research of, wow, this could be really interesting if it triggers, basically the pre-market research gives you a series of if-then statements. If the stock gets to my level, then I potentially want to take a trade here if my risk reward and probability of success mandates that this is an appropriate trade for me to be in, and of course my money management rules. Like that's how we want to be thinking about it. I'm definitely a big believer of thinking about the market in terms of if-then statements, and you're creating those if-then statements based on your rules, and your rules breed consistency, and that's the only way to be consistently profitable. And your rule set is something that does need to be tweaked and adjusted over time because the market environment is constantly changing. You need to have multiple types of trades that you can focus on, not just one type of trade, unless because the market might change in such a way where that type of trade is not profitable anymore for you. I've experienced that in my career. I'm sure a bunch of you guys have as well. So it's a system that you're creating for yourself that ebbs and flows as the market kind of ebbs and flows. So yeah, love the questions there, Zachary, and I really hope it helps. Jack, for Beyond, should you wait for a pullback similar to waiting for GE for a pullback? Both times waiting would have been a better risk profile and would have saved other trades. Sure. So I guess while I still have GE up, I don't know if waiting in GE would be better, to be honest. My experience in trading is that the very best trades only give you one opportunity to be able to get stock at that price. And you either get the stock or you don't. And if the stock gets up to your trigger price entry, whether it's Beyond or GE or whatever, and you don't take the trade right away, and then you're still able to get stock at a later time at a similar or potentially even better price, it inherently means that the trade's going to have a lower probability of success. So for me, if I've identified the level in GE or Beyond or whatever that I want to get in, and it gets to it, like I was just saying to Zach, it's a yes or no thing on if I'm taking it based on the risk I would have to put on and the probability of success. If I decide not to take it, and then I end up in that trade again at a later point in time, which for me, that's going to be a very rare thing, it's usually going to be because a new setup came into play. Because for myself, even if I'm a little bit uncomfortable with the risk, but I want the trade, I'll at least take a feeler. And then I'll look for a new setup as an ad. Like an ad, not an ad back, right? You spent an afternoon meeting earlier this week or last week talking about the difference between ads and ad backs. This would be an ad. You know, GE here, 50 cents risk for GE. I really don't like that, but I really want this trade. I love it. I love the company, whatever. Taking my feeler position, and then I'm going to look for an opportunity to be able to get heavier. I'll do that. Take a look at Beyond. Yeah, no, I think you want that Beyond, honestly, through like 1570. And you could have used this momentum low and you would have gotten stopped out. Or you could have used the low of the day and you wouldn't have. I think that this purchase here, look, in hindsight, it looks like this is a great opportunity to be able to buy. I think that this buy is tremendously difficult, and I honestly don't really like it. I would like this buy if the stock had already established an uptrend off of this low on the way up here, but it was too early in the day. The market's failing. This is looking like, all right, it tried to go here, but the market's failing, and it's going to cause this trade to fail too. I really want this stock the first time through 1570, and then it's just a matter of, am I getting stopped out because my stop was the tighter stop, or am I not getting stopped out because the stop was the looser stop? If you got stopped out because you used the tighter stop, I don't think you did anything wrong. I really don't. You just got pushed out because the market wasn't cooperating early on in the day. From Rex. When you mentioned we should anticipate, not react yesterday, that's pretty much what I did. Okay. I shorted Tesla at 1035 at 175. Okay. At 175 with some resistance there. Yeah, there's some intraday resistance there yesterday. Daily chart looks atrocious, but it's a little bit extended to the downside, so you got to be a little bit cautious on the daily extension. Stock was still relatively weak at this point, right? Where's the market at 10:30? Yeah, super relatively weak. Tesla's super relatively weak on every time frame. Daily chart, small time frame, whatever, got back to positive. You got a little intraday resistance. I don't love the extension of the daily chart. So far, so good. When it failed to trend higher, could you talk a little bit more about anticipating the market? Sure. So I mean, so that anticipate, don't react. It's a saying that I stole years ago from Mark Sperling, and basically what it really applies, like I was saying yesterday, to like this idea of what confirmation actually is. Like a lot of people, especially new traders, their idea of confirmation is basically the trade already worked and now they choose to get in. And that's no good, because whereas I'm already now set for a profitable trade, you're putting risk on for the first time, and you're going to inherently have a worse risk reward and probability of success because you're so late. So we want to see the pieces of information that should give a move, and then see if we can get the continuation from the pieces of information. That's anticipating. Reacting, again, is the reacting, like we called for selling onto this bar at 10:05. Why do we call for selling here at 10:05? Because we had just had a massive move on no news, and the market was extended on a 5-minute chart. It was after 10 a.m. and it was into the spot where I thought was going to be resistance. A newer entry-level trader who maybe is trying to figure out trading on their own or doesn't have good guidance or whatever, they might come in and buy here because they're like, oh, the market's going up. I've got confirmation the market's going up, so I'm going to get in, because it's almost like hard for me to even... I've trained my brain so much now to like never buy this kind of move into this spot. This is where I want to be booked in profit. But I've seen enough, newer traders over the years who would still come in and make purchases there because they're watching the market go up and they're like, oh, I need to be in it, or oh, it's actually going, or oh, this is my confirmation, or whatever. That's reacting to the fact that the market just ripped up and then getting in. We don't want to do that. We want to be involved in the catalyst that created the move to begin with, which is not always easy to do. It's not always easy to do. But we want to be able to find that setup before the setup breaks that can give you the big reward. And, again, today it was the long off the pivot low, which I didn't love this setup, but it was the long off this pivot low. That was a real trade. I am anticipating that off of a fast move into a gap fill, as the market here is pivoting back up, and you could particularly see it with this IWM tail. What I'm anticipating here is that I can get a retracement of this down move. That if you were going long quick, and we got the call out quick here, that you could get a snapback to here with decent probability. And then at that point, do we get a lower high and work our way down, or do we break actually up like we did, which I still would say is a lower probability situation. But by that point, you're in a win-win situation, and you've already booked your profit, and you can just see if you're going to get continuation or not anyway, right? But that's why I was saying have more defensive game plan if you were taking that long. So, no, Rex, I think you were anticipating the down move in Tesla based on where you shorted. You recognized the relative weakness. You recognized it was a resistance. You didn't short like here, right? You shorted at 175. You didn't short at 174 or below after you're seeing that it's working down off of that area, which I know it keeps going and going and going, but I hate the idea of shorting this thing at 173.75. After this move into the moving averages. I don't care that it continues down. So I think that is the right thought process there. You anticipated that resistance was going to hold in a relatively weak stock, and then it would work its way back down. Could you also talk a little bit more about the 945 bounce? Sure. I was going long NVIDIA. Okay. At 9:45, thinking NVIDIA opening above yesterday's high might trigger some stops that could show some strength on the upside. It sounds like a kind of a hectic thought process. When I saw the Qs held to 80, okay, I like this part. I got in NVIDIA around 160 and 70 cents, okay? So I'm assuming that is on the way up here after the Qs kind of held this 180, okay? I didn't put too much risk because my entry is kind of far from the low, also because of the weakness of the open. Rex, I gotta tell you, man, I love the questions. Keep doing it, and I really love your consistent thought process on risk reward and probability of success. You know, I didn't put too much risk on it because I felt like I was a little late. I was putting on you know, more space risk than I wanted to. I still wanted to be involved. But, you know, the market was weak here off the open. We're just looking for a retracement trade. So I decided to take the trade, but to take it with a lower risk amount. That couldn't be more perfect. Seriously, it couldn't be more perfect. I love it. So, yeah, really good stuff there. From Mike Reed, sometimes I feel like my best trades are trades I don't take. It sounds kind of weird. Okay. You should really research on that. That might be like a psychological thing. I don't know. But that's where good journaling can kind of come into play for you if you want to analyze both the trades that you're taking and the trades that you're not taking to try to create an assessment of why you chose to take the ones you took and why you didn't choose to take the ones that you didn't. I have found, particularly with newer traders, that if a newer trader had a list of 10 potential trades and you could rank them in order from the best potential to the worst potential, as trades are triggering, they tend to be in the ones with the worst potential. That is something I've definitely seen in the past. The reason why goes back to what I was already saying earlier. The best trades are usually like the fastest and the scariest. So you have to react faster. You end up not taking that trade, whereas the trade that's a little bit slower and gives you more time to think about it, which also means that it's like not as good of a trade, ends up being the one that you're in. So what you're describing here is not something that is necessarily unusual, but you really want to make sure that you have the personal understanding and reasoning why that is. From Jack, thank you with GE, was more referring to having an entry closer to the opening price on the candle that triggered so that the risk was lower. But now what you're describing is a cheat, I think. You're cheating on the level before it actually triggers. I do that sometimes. And I may have done that in GE if I was watching it earlier, to be honest. I will take a cheat and buy stock before the level triggers if there is enough pieces of information that tells me it's a very high probability that the break is going to occur, and I can therefore get a better risk reward by kind of taking that cheat. You just have to be careful because there have certainly been occasions where I've done that and I've ended up losing money on trades that never technically triggered. It never technically triggered my level. I never should have lost money in it, and I ended up losing money because I took a cheat on the trade because I thought it was looking like it wanted to break, and then it never actually got to my level. Gotcha on the GE Beyond situation. Yeah, I think that if you just use the momentum stop in Beyond as opposed to the low, that it was the right thing to do, and you know, just didn't work out for you on that one. Docu's hitting back down. It came back down, only up 10% now. Pulled back $5+ from Ramon. For important levels, it's almost never an exact price level. It's more like an area of support resistance. Is it best to wait till a stock breaks the lower band if it is support and the upper band if it's resistance? I'm gonna say it's a really tough one because I think it depends a little bit on the situation. What I try to do, so you're accurate. Most of the time, support and resistance are not a specific price. Every once in a while they are, and that's always great. But most of the time it's like a range. And so if I'm looking at a resistance range or a support range, where would I actually want to be taking my trade? And what I try to do is I try to find an important spot within the range whether that was a previous pivot or it's a whole number, or sometimes this is where I still do use a little bit of like tape reading, where there's a certain degree of liquidity at a certain spot that I'm seeing in the tape, and I will round my resistance range to a more specific spot. So I do a lot of that, but broadly I would say that what you're describing is correct. That if we're talking support, you're better off using the lower end of support, and if we're talking resistance, you're better off using the higher portion of resistance. But I don't always do that. I sometimes do that. From EJ, would you please comment on letting a position go and selling it to strength? That IWM 182.50 that I had, call I assume is what C stands for, that I had got to my number, and then instead of taking profit I froze and thought the top level would be revisited. However, the market changed and started going south, yet I found myself not reacting and failing to get a stop, as I must have been a bit greedy, thinking the momentum would have kept going. What rule would you have set and get out at about 10:35? It just held and started hopping. Yeah. So a lot of what you're describing to me in this question is like thoughts and feelings. We really want to try to eliminate as many thoughts and feelings as we can from our decision-making process with the market. I know we can never do that entirely, and I know that as much as we want to try to have a rules-based, more systematic approach, there's always going to be nuances and some degree of split-second decisions, especially when we're dealing with things like extension. But that would be the first thing that I would say to you as I'm reading your question here, as I think that there is just too much of my thoughts and my feelings as the stock was kind of getting to this spot where I should have taken profit but didn't take profit, and I was slow to react and all this stuff. If you just had a game plan that said I'm taking profit into extension, or I'm taking profit into resistance, or I'm taking profit at this spot, then you won't have to be thinking about it or feeling about it. You would just be taking profit into that spot, and that's that. The only other, the main factor for me, because if you do remember, I was calling for profit taking into these highs, was the degree of extension into the time of day with where the market was. And, we even successfully called out that the market would probably fail to give continuation here. If you guys remember that. It was like, book profit on this candle, this 10-10 candle. I'm like, we got to be booking profit here. And this candle, it's like, all right, we're trying to break up. If we want to be extremely strong from a momentum situation, we could give another leg here. That's really unlikely. Why is it unlikely? Is because the degree of extension on this time of day from the 15-minute chart. You guys got to remember that once we start getting to like this 10:15, 10:30 period of time, that 15-minute chart becomes so in play. And I see it happen all the time on both sides of the market, where traders think that they see these like 10:15 a.m. bull flags or bear flags, 10:30 a.m. bull flags or bear flags, after we just had a really big move on a 5-minute chart. They put their risk on, and it's just not that great of a trade if there's that degree of extension on a 15-minute chart, and they tend to not work. That is actually when you will all the time see these kind of like false breaks, where, we've seen a lot this year on the downside. Big early momentum downside move creates a bear flag, 5-minute chart catches up, the time is 10:20, trader looks to be able to short. On certain days this year, there's been so much bearish momentum that trade actually worked, but there's been many others this year, and this was the case in this side on the upside, where you will even still eventually get that downside follow through from the market on some of those bearish days, but you get shaken out on the short of that 5-minute bear flag, because at 10:20 you need the 15 to catch up. And that's really exactly what happened here. While this is going to be so hard to get continuation. You're extended on the 5-minute chart at 10:35 here again. Like, you got extended on the 5-minute chart, you went sideways, ADMA caught up, you are not really extended here at like, this period of time of this 10:15 to like 10:30 low bar coming in. But by this 10:35 high bar, you were extending the 5 chart, let alone the 15. The 15 is going to have to catch up to price in one way or another through time going sideways or through price as far as the correction is. And honestly, if you're bullish, the best thing that you can hope for in these situations is like this sideways price action coming in, or maybe a slow grind in like the most bullish case kind of comes in and this, is catching up, and there's a little bit of a downdraft that comes in around noon, and the 15 is like fully there to kind of catch that noon downdraft type of situation. But this degree of extension, you want to recognize into this degree of extension, you not only should not be buying, you really want to be thinking about profit taking. Maybe you can choose to buy it back. The market will correct those movements. It's basically a law of trading. If there's real news, and that was another fact, there wasn't even news out. If we're talking like Jerome Powell's on the radio or the CPI number like literally just hit, then fine. This can just keep going and going and going and going and going and going. I mean, it technically could even without that, but very, very hard without news. So find that way to be able to book that profit, recognize extension, and honestly, the best counter to overthinking or emotional thought processes is strong game planning. I can tell you, my biggest weakness as a trader has always been my ability to control my emotions, especially when I was a younger trader. I'm like so much better at it now. You guys have no idea. The way that I learned to be able to not trade off my emotions, which was a real struggle for me for a long time, was by having good game plans, by building out good game plans and then following them. Game planning, going back to the conversation that we had earlier about consistent profitability, consistent approach, rules-based approach, that's where game planning, the writing out of the rules is a game plan. And then you follow the game plan. That's where the consistency comes from. So appreciate the question, EJ, from Doug L. So you factor in trend lines. NVIDIA broke a 5-day downtrend today. NVIDIA broke a 5-day. Okay. Yeah, this little descending wedge here, or descending channel here. Do I factor in trend lines? I factor in trend lines. They are not the most important thing to me in my trading, but they're certainly something I pay attention to. The most important thing to me in my trading is my definitions, because it's my definitions. This is great how everything keeps coming back to the same thing today. My definitions are the basis of my rules that create the consistency, right? So for me, more important than a trend line is the definition of a trend, which again is not to say that I don't pay attention to trend lines. We talked about it already with the SPYs. I brought it up myself. I will look at that. I will pay attention to it. It can be a self-fulfilling prophecy. But I also believe that if trading was as easy as just like connecting the dots, like I remember, being like 4 years old with my aunt in the kitchen, like playing the color by numbers, connect the dot, like games that you have. So you want to be able to combine that, which again, I'm not saying don't utilize it, but we really need to be able to combine it with other factors. Thoughts on Pfizer? No problem. Pfizer. Yeah, I don't know. So I always found Pfizer to be an extremely boring stock until it got involved with the COVID vaccines, and then was able to give like just some of these insane moves at certain periods of time. Outside of that, this has always been a super, super boring stock. What I don't like this area that it's trading in. It's within so much price congestion, but you certainly have good strength here and a good trend for the moment. It's actually trying to poke above our trend line high, which shows you just an extreme amount of strength. So yeah, I don't have a strong opinion for you on it. It looks good, trending up for the time being, but it's trending up into a big price congestion zone, which maybe makes that trend stall out a little bit. I have a series of training program classes, EJ. I don't know if you have access to it or not. It's like 15 different classes that really kind of defines my approach to the market. It's a really good supplement to the VTF. Having gone through those classes, I think will actually make you understand the VTF and the things we're looking at and talking about a lot better. One of those classes is a class on game planning for reward maximization. So you reach out to whoever got you involved here in the VTF. I'm not sure if you're actually trading through T3 or what, but just reach out to whoever got you involved and ask, and they can point you in the right direction on it for sure. All right, cool. This was a really good afternoon meeting, but it was a good afternoon meeting because of you guys. You guys made this a good afternoon meeting with the questions that you brought to the table. Please continue to do that. Don't be bashful. Your questions benefit everybody. Seriously, we can probably learn more from the questions that you guys asked than me just kind of rambling on about my thoughts on the market. So don't ever be afraid to do that. It really invigorates good conversations. If you're on the YouTube, smash that like button. I'm going to start saying that more often. And have a great night, everybody. PPI tomorrow morning. Whew. See ya.